Hi, this is George Sandmann, and here is a about 27-minute video in which we go through the equity value planner in detail, and I'm going through it with Tim Rhode, C3D. He's the Growth Drive 2025 Member of the Year, and working with these tools in real client cases. So thank you to Tim for his willingness to record this session. And here we go. Here are complete instructions for completing and explaining Growth Drive's Clarity Software Equity Value Planning module, which really calculates what the business will need to be worth so that the client can meet their wealth and legacy goals. All right, let's go. Here we are, Tim, and thanks, man. This is going to be a fun conversation, and we'll walk through completing the equity value planner, reading the analysis, right? Explaining the analysis. And then I'll finish, if it's okay with you, by pointing out how this powers the simulator module, which is over here. Cool?
Yes.
Okay.
Really, what I'm looking for are graceful ways to explain each of these frames, each of these widgets, in a manner that would make a business owner who has maybe known me briefly to be comfortable, trusting, and forthcoming with the information. While I'm clearly not a financial advisor, let alone a long-term trusted financial advisor. I don't want to speak erroneously or misrepresent what any of these mean. So how can I ask and solicit their information and give them feedback on each one of these to help them feel comfortable moving forward? And then especially at the end, how to use the variables at the very end to help show them different scenarios that go from being, uh, you know, uh, disbelievable to something that, hey, I can accomplish that.
Yeah. How do we show them
Right.
that the future is possible?
Right. With
Because
our help.
with our help, yes, with our help. And so, a couple of comments about Equity Value Planner. I created it working with several people, some of whom are wealth advisors, and working with some of the senior leaders at in exit planning. And also, but I think importantly, two of the models that were shared with us were from business advisors who have built Excel models to lead this conversation. Because what the conversation is meant to do, so we need to start with where have we started with this client? And I'm going to make a couple of assumptions if that is okay. Assumption number one is that we've had the growth conversation at some level, hopefully a complete growth conversation, right? Where where are you headed? What is your wealth goal for your family, your legacy goal? How do you define success through the end of your career and in the next phase of your life? How do you define success? And what we measure success by? And then we can talk about the business's capacity to deliver those goals. And they're very typically wealth and legacy goals, which are obviously overlapping. And then assumption number two, we may have asked 3 questions on that, or spent a big chunk of time, a couple of hours, the 3-hour business dinner, having a deep conversation, a deep discovery of that destination, of that intent. So we talk about that in C3D, and I'll leave it alone from there. We also must have completed Clarity Level 1. So here we are, this person has completed Clarity Level 1, and we have their business information and their report. And when you click Submit in Clarity Level 1, it pushes this data into relevant parts of the system. When we've done that, we can have a conversation about value, right? And this business, we don't have their discounted cash flow information. That's fine. We know that this is a business that at top strategic capacity is worth $30 million but the current transferable value. And with strategic capacity of 41, we of course would be saying, if you try to sell this business, it is going to be very unpleasant. And if you do, you're going to leave a huge chunk of money, $18 million on the table. So, and these are good numbers, so you know that. So now they've said, okay, well, now we need to know if 12, 30, or some other number will be sufficient to meet their wealth gap, right? So we have a business value gap that we've identified right here, you know, um, a business value gap of $17.7 million. That value gap typically contributes to a personal wealth gap. And that's the conversation we're about to have using the equity value planner. Opening it is very easy. We just click on equity plan, and here we are, and it's blank. I'm going to bring this back up to full size. Okay. So here we are in equity value planner. And now we're able to say, so we know, I'm just going to go back one more time to clarity level 1. We know that this is a business that's doing 50 million with 5 million of net profit. So it is a profitable company generating jobs, generating revenue for the government, generating a nice income for the owners and hopefully the senior leaders. So we need to have the next equity value planner is typically in that context. So,
And net income there would be the equivalent of EBITDA.
yeah, yes, but we're not. And the only reason we're not saying EBITDA is the best number to put in there, but we don't want to talk past our clients, right? So let's just talk in terms that they understand. Well, we can sharpen their understanding as we go through the process. But right now, what we don't want to do is get stalled explaining what EBITDA is and why it's relevant, why it's
Understood.
net income is a great placeholder. Okay, well, I'd be saying, okay, man. Now, as a business advisor, it is absolutely appropriate to have this conversation because your role is to grow typically is to grow a couple of numbers. We want to grow revenues. That's 62% of CEOs, right? I want to grow revenues. Great. And your magic is that you can also increase their strategic capacity, which will grow revenues, but will also help them access a higher multiple, meaning we're going to get a higher revenue number that we're multiplying by a bigger, so we have this compounding effect of the work we do. We are different than, just profit growth people. And it's so tempting to go on a tirade about growing value and but I'm not going to go there. When you focus on growing the value of a business, because this is being recorded, you will you cannot avoid, it will automatically, typically pop the revenues. All right. So we're going to call this guy Tony, and Tony, that's great. So, remember we talked about the fact that you want to take care of your family, what do you need your annual income to be in retirement, total, including from all sources? And so maybe Tony's running a $50 million business that's throwing off 5 million. He might think that 1 million a year is cutting back, right? But we're going to use easy math. So my annual income is $1.2 million, right? I need $100,000 a month. Great. Now we can start planning.
And George, not to interrupt you, but you're talking about pre-tax or after-tax income there, in case it comes up.
I'm just talking about pre-tax income.
Pre-tax, that's what I was.
We don't. What this is not is a wealth planning module. What this is not is a tax planning module. Those are specialized services that I would highly recommend we get into. And we're going to get into tax planning in a couple of minutes. But what we want to do is let's just focus on the big number.
Yep.
Great. How much passive income are you getting? Will you be getting in retirement? Not well. Listen, I actually own the manufacturing building, and the rent is whatever it is. I'm just going to put a number in here: $100,000 of passive income. I've got rental properties. Great. The next, okay. What's our withdrawal rate? 3 to 5. I like 4. It's conservative. So we'll put it forward. That's what we expect the market to return. That's a nice conservative number. Net of
And
inflation.
that's the number at which you're not diminishing your total value, right?
That's correct. You've got your assets under management are not being depleted. This is how much it's throwing off. In good years, it'll throw off more that you'll reinvest. In bad years, you're going to pull out more, and it averages. And this is where a wealth advisor. Now, imagine that you're sitting with a wealth advisor at the table. That's scenario one. The wealth advisor can comment on this. So you're doing the play by play and they are doing the color. I would not have the wealth advisor drive the software. You know the software. You're familiar, and you are the growth advisor. You are the person who's going to drive the growth of this business and make this reality come true. The wealth advisor, in terms of the business assets contribution to wealth, the wealth advisor has very little impact, right? They can suggest, insurance. They can suggest some advanced planning and suggest and provide. They can suggest and provide some components that will typically just protect the value of the business. But in terms of making business value actionable, the typical wealth advisor. Now, we have a lot of wealth advisors who are leaning into this, but the typical wealth advisor, your typical SEPA or CEXP, is not doing this kind of work, which is why these collaborations are so powerful. Now, cool. Now, we need to have an investment portfolio that is worth $27.5 million. Big gross numbers. And again, we're painting with a medium brush, right? Now, how much wealth do you have? And they're already sharing their revenue with you. And now this becomes, it's partly qualifying. At this point, you have established trust, right? If they're willing to get into this conversation. So we need to know how much wealth you have outside the business. Oh, well, I have $5 million in my Charles Schwab account. Great. How much debt do you have to pay off? Non-mortgage? Well, listen, I bought a boat. That left a little, I'd like to pay that off out of the proceeds. I'm just going to keep it simple, right? 250,000. So, and you see how these numbers are adjusting, 22 and $23 million. Okay. Now, what are the net proceeds from the sale of your business that we're going to need to fund your wife's out? How much of the business do you own? And I'm going to keep this interesting. So let's say that your client owns 70% of their business. Okay, great. How much long-term business debt do you have? Well, we just bought a bunch of machines. We're getting a little bit into balance sheet. Okay, but we're at 36,000 feet. We're having a conversation. This is to educate the client. So it's purposefully relatively straightforward, intuitive to complete. Well, I just took out a big loan on a building and some machines, $2 million.
So in long-term business debt, there is anything that's amortized out more than a year, right? Just
Yeah.
per
Yes.
operation, right?
Yes.
Not a lease or anything like that. It's
No.
just
No. What's going to be showing up? Yes, that's correct, Tim. And
this would have to be retired at sale. So let's say if you're selling your home
that's
and you owe 2 million on it, you'd have to retire that mortgage.
at which, and the reason this question is in here is in large part for education, because many business owners do not appreciate that when they sell when they sell the home, when they sell the business, they're going to have the debt is theirs. They're unencumbering the business. Okay, and they can get angry about this, but this is an irrefutable. This is
Now, did it automatically take 70% of that debt, or did it lump the whole thing down there?
Oh no, it lumped the whole thing because he's not responsible for. I mean, the shareholders are responsible for the 2 million, but the calculator is applying that 2 million. So now we've gone from 22,750 up to 24,150. Okay, now we're educating the client. You're going to have to pay the investment bankers, the lawyers, the accounting professionals, and potentially some others. And that's going to put a load. That comes off the top of the transaction. Not going to surprise you. Your real estate agent gets paid first. These professionals get paid first. So I typically use 8% as my number. 6 for the banker, 1 for the lawyers, 1 for the accountants. That's a good conservative number. You could use 10 if you want it to be a little more conservative. Taxes. We all have a silent partner. That silent partner's name is Uncle Sam. And if you don't do any tax planning, we're going to have a tax burden. That tax burden makes has a big impact. So now I need to get the business. My lifestyle is supported when the business is worth $51.5 million. Cool. I'm going to scroll down. Here are my current financials. These have been pulled from Clarity Level 1. We're in the manufacturing industry. We could change industries here if we wanted. We're not going to. For this business, in this industry, at this revenue level, we would expect your multiples to be somewhere 3% to 3x to 6x. Because again, this is financial. From a financial value perspective, right? Not strategic value. Strategic value is gravy and frankly impossible to calculate. It's in the eye of the beholder. Cool. So here is my range of values for the business. Remember that 30 million, 50? So here's the range at the low multiple, 14, high multiple, 30. Okay, great. So now we get into the magic. When do you want to have the option to sell the business? When do how far out are you? And we go up to 10 years. I think, if like, well, I'm going to hang on to it, but let's look at a 5-year horizon. Yeah. Okay. Does that work for you, Tim?
Yes, it does.
Okay. And now my multiple, you'll notice it's not filling it out. I'm looking over to the left here and saying, okay, well, let's assume that you are able to successfully transfer the business at the low end of the range of multiples. We're going to make it, this is a conservative analysis. And my profit margin is 10%. I'll just put 10 in here. And I'm going to click. Now you'll notice that my required growth rate is 0. When I click calculate, it is going to take all of the data that we have just manually input and calculate a rate of growth for the business. So Tony is currently generating 50 million a year. In order, net of all of these other burdens, all these other calls on the transaction, he needs to get the business from 50 million of revenue to 172. He needs to take his EBITDA, which is the number in manufacturing we care about, from 5 to 17. Needs to grow at a compound annual interest rate of 23%. Now, the reality is, how likely do you think it is that he can maintain a 23% growth rate over a 5-year period?
Yeah, not likely at all.
Yeah.
28%, and it's like I want to go curl up somewhere.
Yeah, exactly. And that's the thing. So what we want to then say is, listen, now the first reaction we often hear from business owners is, well, I don't really need 100,000 a month. It's like, but before we start messing with that, that's the last number we want to mess with. And we'll only mess with that number. We're only going to change that number if absolutely required. Because let's run some scenarios. Now, the first thing I like to do is to say, now the wealth advisor is probably going like this as well, because the wealth advisor has never seen this math. The business owner has never seen this math. And let's pause for a second, think about what the business owner knows, what they've learned through just this conversation. So they've learned about strategic capacity separately. They've heard themselves say, I'm not top of the charts in these areas. Now we're going through Equity Value Planner, and they have a business that's throwing off 5 million a year, so they think $1 million, that's reasonable, and it is. But what they don't know is all of the things that they're going to have to do, all the hands that are going to be stuck in the pie after the transaction. So the first thing I like to do is this is our power, right? This is our superpower, is helping them increase strategic capacity. So the first place I like to go is to say, well, listen, what if we can increase your strategic capacity? You're a 41. if we can increase your strategic capacity to a point where you can get a higher multiple. So we're going to get the quality of your business, the confidence that an acquirer would have that you have low company specific risk. What if we get your multiple up to a 5, right? Not 6. Let's stay conservative. I'm going to move it to a 5. I click calculate. Now we have to grow. If we can increase them, there are two numbers we're multiplying when it comes to value, right? Revenue and the multiple. Revenue times multiple equals value. Great. Now we have to grow from 50 million to 103 million. Now you're telling me I have to double the size of the business in 5 years. I'm already saying, all right, Tim, how do I increase my strategic capacity? How do I attract, how do I frankly command a higher multiple? And I might be saying to the business owner, well, that's not all. There are other things you might consider doing to de-risk hitting that number. What if we could add 1 point? By the way, you and I know that this will happen pretty much automatically when we increase strategic capacity. But what if we can add 1 point of margin? Okay, now we have a warning. This is manual input. It's not the same as. That's just to keep us eye on the ball. It is now doing a quick calculation, and now we have to grow at 13%. Okay, so I'm taking a couple percent. Doesn't sound like much in year one, but when you're doing it year after year, now we have to grow from 50 to 93. You're throwing 5 million off a year. What if we can use that money over the next couple of years to buy back 15%? Let's get your ownership up to 85%. Let's help some of your other shareholders get chips off the table. I don't know if that's possible or not, if they'd be willing or not, but let's just say that they are. Now we're using the profits to buy future wealth. Now we have to grow at 9.32. Now, right now you've taken the business owner, like you said, is going to be curled up in a ball. And now you're saying you just have to grow at 10%. But the most important thing, and what I bring, Tim Rhode bring, what I, as the C3D, a growth driver, bring, is the unique knowledge to increase your strategic capacity. Strategic capacity will drive your multiple. And I want to help you go from being hat in hand to having a bidding war for your business. And a business with high strategic capacity should generate a bidding war, all things being equal. Okay. And by the way, if I take this profit margin back to 10, it has an impact, right? So it's almost a 2% per year impact. But I just want to show the power of 1% of margin. Great. So I have to grow at roughly 10% a year, compound annual growth rate, over the next 5 years to get there. And if we can do what we're also doing is saying, hey, man, you might be able to get out earlier if you do this work. So that's what the equity value planner, that's the conversation. So I'm sure you have questions.
Now, this has been outstanding. This is exactly what I needed to see and hear and show which of those variables to play with. Like, I would not have thought to go up and suggest buying back a fraction of the partnership interest. So that was helpful. And I would think that increasing those margins by just a point is a pretty conservative approach, that many people would want that to push 11 or 12 or maybe even 13. And then that gets baked into the OKRs from the strategic growth plan.
That's exactly right. People productive and loyal. How do we add efficiency? SOPs. We're going to add a lot of efficiency. What's counterintuitive, if we say to a business owner, well, we need to double the value of your business, they sort of think double the work. But what we're actually we're going to make the business easier to run by focusing, right? By focusing. And as we make the business easier to run, revenues actually pop, which is counterintuitive. So you're going to have a better quality of life and be making more money. And this is not magic, but this is what private equity does every day. So you're actually saying to the business owner, hey, you can lead a self-directed private equity play on your own business, on your largest asset, and generate a huge reward. Now, I'm going to click submit to lock this in. Got, if you see a submit button, ladies and gentlemen, mash it. I'm going to click submit. There are not very many places in the software, and there's no harm in clicking it. Um, well, so now I've clicked it. What
If I
does
didn't click that, does that stay in the equity value planner, or does it just and
um,
does not go to the simulator, or what happens with it? Does
you
it
want
go?
to push this? You want to push the data out there. You know the software is written to save all of your entries. However, I do not control the connection between your computer and so if there's any kind of hiccup in there, which is rare but could happen, your work might not be saved. Now, if you've been recording it, if you're using Claire's scribe function and you're recording the meeting, then you have a transcript of this data. You can go back and fill it back in again. You're not hung. But the software is designed to save things, even if you don't click submit. And when you click submit, it pushes the data. It is an active step of pushing the data where it's needed. Does that make sense?
Yes.
Awesome. Okay. Well, the next I might be thinking, now this Tony has not filled out clarity level 2, right? If I go, you can see all of these. There are no updates. Nothing has been created. I'm going to click on simulator. What do we know in simulator? Now we have strategic capacity of 41, and we're not. We haven't pushed. We haven't done level 2. Um, Yeah, I haven't completed level 2, so I can't go in. Once you've completed level 2, Tim, and I will go and show you how this plays out in a different I the we are now linking the equity value planner to the simulator and able to say, okay, over 5 years, if we do these, if we have this impact or generate that result, then here's how it will impact gross revenues, net income, and transferable business value. So Simulator is a powerful add-on to that tool. Before,
I'd love to come back and take a look at that because I'm in exactly that place with a client right now. We've not done the equity value planner, but we've done Clarity 2. And
great.
be able to go in there now. What I'm wondering is that now we can demonstrate or we can show or display, probably more accurately, how much trapped value there is in leadership dysfunction, right?
Yes.
And
Yes.
we go in and we slay, let's say, 4 of the 6 leadership, um, dragons, the objectives that need to be accomplished or the key results that need to be accomplished there. How much value does that release, and what does that do back to the equity value plan, or what does that do to the strategic capacity, right?
I love it. I absolutely love it. Yes. So let's look at that right now. I want before we do that, Tim, are you okay for time?
I have about 10 minutes.
Okay, perfect. There's this other tab, strategic capacity and price, and this is a very simple what if. We have our current strategic capacity of 41, and this is what would happen if you move the business up to best in class. Well, you'll notice that the revenues track straight across, but we are adding 37%. But here's what happens: we are getting a price premium. Um, we're going to start getting a price premium. We get a due diligence multiple of 2. Now we think that we're going to get a multiple of 4. It's very conservative, and it's going to do some other calculations for you. So if you increase and this is the most valuable window. If we increase your strategic capacity by 10%, and we grow the business by 10%, how does that play out over time?
That per year,
Um,
those numbers are per year. We
this is
increase the
yes,
capacity by
yeah.
10%
This is
year.
so this is per year, and the compounding effect.
Got it. I see it there. Yep.
So I'm going to pause sharing for a sec, and I am going to go into a completed uh one a we're going to go into Ridge again, a teaching case, but where we have completed. And where's Diane Ridge? There she is. So we're going to go into, so here's clarity level 2. All right. And resume. So this is Diane Ridge, Ridge Specialty Tooling. This is our teaching case. And we have completed level 2. Now, you asked a question. One, when we go into the analysis dashboard, which is a place where we are developing additional onboarding assets to really focus in on this, we are now, as is not surprising, this is the CEO. Tony, who we just worked with, was the COO, and he's not exactly dialed in on, he doesn't even understand how much money this business is making. That is not irregular. That is something that we see. You see it, right? And we see it in the compare, doing the senior leadership alignment. We see that routinely,
Yeah.
where people have no firm grasp on how the business is doing from a financial perspective. Okay. So she has 54. This is the same business with 5.1. So at least he was close on EBITDA, which means the calculations of equity value planning were by and large correct, right? They're within $100,000. And so when you're focusing in on the changes that you're going to be making, I'm scrolling down here on purpose. And I'm not going to, I'd be happy to come back and talk about how to explain this. But the bottom line is you want to grow. So they've said that they are preparing to sell the business. We have a value gap of $13.5 million. This is the CEO's view of the same business. So horseshoes and hand grenades, same. Here are what is holding back growth. Okay. You don't have people who are efficient with low turnover. You're not generating a maximized amount of recurring revenue. You're not, inadequate customer satisfaction data, et cetera. When I scroll down here, now there's a fork in the road. Do we want to talk? Preparing to sell there are 3 use cases, right? There are 3 dimensions. Make my business easier to run, help me grow this thing, or help me maximize the transferable value. Help me prepare to sell. And clients can show up in one place, disappear, and pop back up somewhere else. Like, wait a second, I can get 13, So when we start talking about the value of increasing senior leadership, we have the value at high strategic capacity, and then the impact of low strategic capacity on that transferable number. And that is the trapped value. It's value that's real, but that cannot be monetized. So you talked about effective senior leadership, and I'm just going to drill down on this for a moment. If we think about the value of the business as being supported by pillars, right? Value is made up of components. And those components, in our view, can be divided into 24 different pillars, buckets. And so having an effective senior leadership team, now that there's another fork in the road. Having an effective senior leadership team means the business is going to be more valuable. The business is going to be easier to run, and the business is more likely to successfully complete due diligence, right? An acquirer wants to know that there's a team in place that when they take out the founder, whether it's now or at the end of an earnout, there is a team in place who will keep this asset growing. The private equity is not interested in jobs or in buying a job. They are interested in buying an asset, and an asset in which they have high confidence that they can generate a return that meets their promised return objectives for their investors. Cold, but it's a fact. So when we look at effective senior leadership team, we're saying, well, that contributes $1.9 million to the potential value of the business. And because you do not have an effective senior leadership team, and we'll look at this in a sec, you have 770,000 trapped. However, you and I know that if they don't have an effective senior leadership team, it's trapped. But it's also, I'm going to scroll up, and it's going to be a deal killer. There we go. You can't complete due diligence. You can't successfully sell this business if you don't have an effective senior leadership team. That's to private equity or to the private capital markets. And if you're going to do a management buyout, you also want to make sure that you're not being dragged back in. Every time I get out, they pull me back in. Marlon Brando. We we want to make sure that there's an effective senior leadership team in place because our client is likely also going to be the bank. They're going to hold some or all of the financing paper for the management team to buy them out. So strategic capacity is relevant across all of these exit options. So and then what I would be doing if I was talking to the senior team is I might then say, okay, so once you guys get that concept, let's look at how you're doing. Your average score in dimension 1 is a 59. Now, for senior leadership, you're a 60. We want these to be 70s, right? At 70 is our minimum to start contemplating a transaction. Getting from this business is what is the CEO? Let's say that this is the consensus view. We have strategic capacity of 56. Okay, so getting from 56 to 70 as an order of magnitude, it is hard. And it's not 14 points. It is very hard and likely going to take a year or two. And it's well understood, but just because it's well understood doesn't mean it's easy. So I would be going down here and saying, okay, guys, before we look at the value, we need to make sure that any of this is transferable. And at a 54, you're not going to successfully complete due diligence unless we find that unicorn strategic buyer who doesn't really care about due diligence, just simply wants to acquire you because of your IP, because of, some reason that is going to make them write a really big check and not look too closely at the engine. And then we can go through, they're doing well on margins. Then we can go through these scores, but and this is where we get into planning. Now, Tim, I know I'm going to round it out here is it any questions here before I click on simulator?
No, this has been great.
Okay, I'm going to click on simulator. Now in simulator, what we have is now we know we can benchmark their gross revenue. We can benchmark how they're doing against their industry. We can remind them, this is an education point, inflation takes a bite out of your 12% here, right? So everybody's going up by 3. You're going up by 12. So your net gain is, when I go down in simulator, I'm going to scroll down and what have I have gone and changed? Okay, so if I put in the equity value planner here, I'm going to click on this. That changes so if I click sync with the equity value planner, it is going to sync the entire simulator with our inputs from the equity value planner. Now, remember,
This is new, right? This is new.
Yes, I've jumped from Tony to Diane, so we're going to see some slightly different data, but the use case stands. So I've just synced it, and we have our sustainable growth rate that comes from financial data. I won't get into that right now. And now we start to look at what does this look like? We do it in numbers and calculation and tables. And then I'm going to scroll down here and we do it in graphics. And these graphics, which by the way, you can grab, right? You can download them. You can view them as a data table, etc. I'm just going to hide data table and we can start saying, okay, well, now here's what I might be saying to Diane. Let's focus on value. Well, you want to focus on revenue or value?
Value.
Okay, so I'm going to scroll down. Value starts with chart 3. So we do gross, net, and then we get into value. This is at current strategic capacity. And I'd be saying, Diane, your industry is growing. You are underperforming the industry. So here's the value that's required at your required growth rate. You're going to need to grow this fast to hit your equity value planner goals. Your sustainable growth rate is lower than that. So you don't have enough cash flow. So now we're starting to have a more sophisticated conversation and we're creating awareness. And this might be Diane, I'm not a numbers guy. We need to talk to your CFO. Diane, I'm not sure your CFO is carrying their water. We need to bring someone else in. Diane, you need to think about this. There are some other, well, we're starting to have a very sophisticated conversation about this business. Now we have a manual override for the increase in strategic capacity. And I'm going to refresh this.
Can you go back and unsync that, or once it's synced, is it done?
No, 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 you can. So I'm going to go back to Equity Value Planner, sync with EVP, and please click submit to save this change. So I'm going to click submit. Okay. And we're going to scroll down here. And um, so here's our gross revenue, net, and our current strategic capacity. And then we get into, Tim, what? Shows a manual override. Well, it's not showing me. God bless it. I'm going to figure this out.
That's all right. I need to run anyway. So,
Okay.
but this has been very helpful, more than I was even hoping for. So maybe we can do episode 2 where we do the transition from the equity value planner all the way through the simulator, which would be very, very helpful. I've not gone there yet.
Okay. Great.
That absolutely gave me great confidence in working with the equity value planner and seeing what next, like how I can tie that back to their future. Right.
Yes. And um, if you were sitting down with a business owner, you don't have a wealth advisor in the room, I would be asking a couple of questions. Do you have a wealth advisor? Yes. Who are they? It's Nile. Great. It's Jane Smith. Terrific. Now you take that EVP chart, and is it okay if I share this with Jane? And let's assume they say yes. You're going to send this to Jane, and you get the equity value planner, and say, "Hey, Jane, here's some data I generated on our mutual client. I thought it would be helpful for you. This is the type of data I generate. Would you like me to, would you be interested in meeting people who don't have a wealth advisor? Do you have clients who might benefit from this type of analysis, et cetera, et cetera?" So that it provides an entree into potentially a new strategic COI. And if they don't have a wealth advisor, you're like, well, hey, I will introduce you to Peter. And Peter would be happy to have this conversation with you. It's free. It's lunch. You're going to get a free lunch and some insights. Let's take the meeting. And okay. So it could be a
So helpful.
terrific biz dev opportunity.
Thank you so much. And please send me the recording or the transcript or all of the above on that, because it'll be very, very helpful. I'd love to go over it with Tony as well.
I will send that to you very shortly.
Thank you, sir.
Okay. Thank you, man.
All right. Have a great weekend.
Yes, sir. You too. Bye.
Bye.